It's Brian Preston, the money guy.
This is from Boxer Pete.
Uh-oh.
Don't make him
Don't
mad.
want to, yeah.
My student debt is at 2% interest rate, and my retirement investments average about 7%. Should I pay off my student debt or continue to invest in my 401k?
No, look. Pete, that silence for all those out there in podcast world is because I'm holding up the free deliverable.
Free.
Moneyguy.com/resources. This is the 9 steps of the financial order of operations. Here's the thing. Number 1 is deductibles covered. Number 2 is that free employer money. So that's 401k money you better be doing to get the maximum from your employer on that match. Number 3 is high interest debt. Now, here's what's interesting. 2%. Do you classify that as high interest?
If it was on a savings account right now, I would, but in debt terms, absolutely not.
I mean, it is definitely different than credit card debt, auto loan debt, and other things. So I would tell you, if you have a 2% interest rate, I would focus on trying to get those army of dollar bills, because while you're young, I'm assuming since Pete has student loan debt,
He's probably early in his journey.
He's early in his journey, so building those army of dollar bills up is super important. So you might want to move beyond step 3 and get into emergency reserves, Roth and HSA, and then maxing out retirement. But there is going to come a point. Here's what I would encourage Pete is that we tell you to save 20 to 25% for retirement. I do think after you get past saving for retirement, you do need to get aggressive with knocking down even low interest debt you can consider doing. And I don't have the deliverable, maybe your memory's even better than mine. We have the whole risk-free rate of return, and we have by age group.
That's right.
And it was 20-year-olds have a different rule than 30-year-olds and 40-year-olds, because we don't want you to be 50 years of age with student loan debt. So there are varying degrees of where you are on paying off student loans.
Based on the equity risk premium, which is just a really nerdy way of saying.
That sounds fancy.
Based on the reward you get for taking risk, here are kind of our guardrails we have in place right now. If you're someone in your 20s and your student loan interest is below 6%, your army of dollar bills might be more powerful. You might want to prioritize that. If you're in your 30s and your student loan interest is below 5%, you may want to continue focus on your army of dollar bills because it may be more powerful than satisfying that debt. If you're in your 40s and your student loan interest is below 4%, it's probably okay to continue focusing on your army of dollar bills and letting it grow. Once you get into your 50s, when you can kind of like see unless you just went back to school, and if you just went back to school, you probably should have saved for it, cash flowed it, and not had to go accumulate student loan debt. But if you're in your 50s, you shouldn't have student loan debt. That's kind of where you graduate past having that student loan debt, and you should prioritize getting rid of it. Your army of dollar bills is so powerful in that 20, 30, 40, that even when you adjust for risk, 7% in equities, 2% debt, even when you take risk into consideration, which is what you have to do, you have to also take on the opportunity cost risk, how much more valuable your dollars are today than they will be 20 years in the future. So I think that I would focus on that.
And that's why I hold up, once again, the financial order of operations. Number 9 is low interest debt, not high interest debt. That's step 3, but low interest debt. And I would say a 2% student loan definitely falls into low interest. So you got a lot of meat on that bone to get through on the financial order of operations before we focus on 2%. Because remember, army of dollar bills needs to work for you, and there is a standpoint. That's why I love putting the age stuff, is because yes, risk is a big part of it, but once you get over 45, approaching 50, you're also thinking that's why it is you're minimizing the risk over time.